Welcome to the daily update, where I'll go over the action in the market for Tuesday, September 2nd, and we'll see how things look for Wednesday, September 3rd. Well, okay. It looks like, at least initially, when folks came back over the Labor Day weekend with the long weekend of barbecues and fun, they decided to sell rather than buy, at least at the open. Now, those people that came in a little bit later, they decided to come in and start doing some buying. So we were down quite a bit more earlier in the session than where we ended. And that's impressive. There's some buy the dip going on later on in the day. We still ended up down. We're still seeing some weakness. We closed below the 20 period moving averages, so we're negative now in the short term. But right now, it's just looking like a pullback and locking in some profits. The market's still getting a bit more defensive. We're in a weak seasonal time. We were in August, but that didn't play out. We were actually looking at this going back to the middle of July. That didn't play out either. I would prefer to be aware of these things and see if the clues are happening for these declines to take place and not have them happen than to have a decline happen and not even understand why it's happening. So that's kind of where I come out on that. That's why I look at more charts. That's why my videos are longer, because we're trying to look at little changes throughout the market that give off these clues that can give us some insight as to what's happening. Okay, now we saw it on a seasonal way going back to the middle of July. We didn't really see it come through in the charts. Then, as we worked our way through August, we saw little bits here and there starting to come in. Now it's starting to build a little bit more, and we'll see if September ends up actually being more weaker overall. All right, so right at the open, we had a gap lower open. The futures were already down. Europe was lower. That dragged the S&P US futures down as well. And then we had some economic reports that came out that it just was one of those, at least at the open, one of those days where no matter what was happening, we were going to go down. So we had a gap lower below S1, 64.39. We immediately went below S2 at 64.18. Right after the open, we found initial support at S3, 63.71. I had to break out the pivot point calculator. And if I would recommend that if you don't actually look at the charts that I post, go to the link. If you go to the YouTube community tab on the intraday pivot points that I post, there is a web address that'll take you to a free calculator where you can know these well ahead of time before the market opens. And they're pretty important. And especially if you're in the little bit shorter term time frame. But we rebounded off of S3 because the software that I use, it only calculates up to S2, where the pivot point calculations, they go to S3 and 4, I believe. But then we tried to rebound up off of that, but then we stalled at 6,400. Again, we come back up to a round number, a psychological number, which over the last few months has turned into more of a technical level as well. And then we declined below that. We went actually down below S3. We found support at another kind of round number. When I talk about round number, I'm talking about 6,200, 6,300, 6,400, 6,500. Well, also kind of in between those, of course, is another round number like 6,360, or it would be 6,350 or something like that. Then we started to rebound after the selling got done. We got back above S3 and we closed just a little bit under S2. So it was fairly impressive as far as the intraday action. And I'll show that chart here. We were down 0.69%. We were down over a percent when we were hitting those lows there. One thing that you could say in this context is more encouraging is that volume is still below average. One of the things that I was pointing out over the weekend videos that I post, it's like, okay, now that Labor Day is done, folks are going back to school, they're done with vacations. Are we going to see volume pick up? Not in Tuesday's session. So that hasn't really come into fruition, at least yet. And then we saw the down day on Friday. That was also on below average volume, but that was also the Friday before a 3-day weekend. So we're now negative in the short term because we're below the 20 period moving averages. And when I use that plural averages, that's the simple and exponential. I plot both of those and I'll show you that chart as well. Interest rates ticking back up here as well. And the market, again, if you watch the weekend videos, I go through in a couple of different videos, we really look at not what are people saying about inflation, but what is the market saying about inflation? And there's some ratios that we look at there. Market's not really worried about inflation right now, even though the PPI report came out now a couple of weeks ago, and that kind of started this whole worry about inflation. That's still in the back of the mind of the market, but you look at the bond market and different ratios, they're not really all that concerned about that at this point. That's why we watch these over and over again. And now, of course, that we've had two down days. It's like overvalued, overvalued. Okay. Well, yeah, valuation is something that we use. We like to know about it, but you cannot use it as a timing tool. You would have missed out on some of the biggest gains that the stock market has ever had. And if you get out when we do become overvalued, you leave a lot on the table. If you try to get in when we're undervalued, then there still might be more damage left to be done. So again, that it's good for information, not very good for timing to make decisions there. And then, of course, there's geopolitical things going on. There's meetings happening. There's things in the Middle East and all of that. Not much of an impact as far as how it's impacting the market overall. Okay, and then no real trade news or tariff deals or so forth, at least yet, but that could always change. So the market there, it's concerned about elevated valuations, but the market's been overvalued for what, 3, 4 years now. So it's like, okay, yeah. And then historical seasonality. Now this is more practical. September is the worst month for stocks historically. And August is not very good. We had never had a positive August in a post-election year going back to 1950. This year was different. We ended up being up 1.91% for the month of August. So we broke that seasonal tendency there. But September does tend to be weaker. Is it really going to happen as far as some kind of a decline? And then the fallout from the U.S. Court of Appeals ruling that President Trump's enacted tariffs are illegal. That was an appellate court. It's going to get kicked all the way to the Supreme Court. And we'll have to see if that's within the president's power or not. But for right now, they're in place pending a potential Supreme Court appeal. So then for the day on Tuesday anyway, mega caps were weak, but the late buy the dip interest saw late day buying. And that's encouraging when we're really going down and folks say, oh, I can get these on sale now. And they come in and they start buying and it drives prices back up. That's more of a healthy thing to see. Small and mid caps, they held up slightly better. They were down, but they were down less than some of the other areas of the market. And we're still seeing this gradual shift from growth over to value. And that's when the market is tending to get more defensive. We're not seeing it across the board. We're not seeing longer term trends change. We're seeing it more to, okay, here's September. Let's deal with this. The market may be getting more defensive. It may be going down in September. So we're just going to position ourselves for that. That's all it appears to be right now. We're under the 20 period moving averages with the S&P, and then another primary indicator is the parabolic SAR. It has also turned negative, and that's more intermediate term, where the 20 period moving averages are short term. And we still have our stochastics chart looking extreme positive, but that's coming down pretty fast. It's really the longer term part of that chart where I subdivide the short-term time frame into short term, intermediate short term, and long short term. The long short term stochastic is coming down, but it's still extreme positive. We already have a couple of things on the extreme negative list. This is suggesting short-term momentum is switching over and looking more negative. We have the Stoch RSI and the CCI 14. They're already showing that more negative momentum. Now, if we continue to go down, this list will get longer and they'll just show that there's more conviction to the downside. Where after last Friday, we were going up, we were looking better, the market was looking fairly positive, and then Friday happened and we went down And that pretty much wiped out any of the positive conviction that we had been seeing building up over last week. Well, now we're starting to see a little bit more negative conviction developing. Is that going to continue? Are we going to be able to bounce up out of this and then wipe these two charts here that we're seeing more negative conviction being developed right now? Then in the long term, we're still looking a little bit extreme, but now we're really declining here with the Sean trend meter. We took the long-term extreme readings off right now. No change right now to the overall scenario. Now we are going to get the employment report on Friday, and we're going to get employment data released throughout the week. So Thursday and Friday are going to be pretty hefty as far as employment. One of the reasons the Fed has been reluctant to cut rates is because the employment situation has remained intact fairly well. And if that starts to weaken, what's the market going to do? Because they want that to stay strong and they want the Fed to cut rates at the same time. The context is the market wants the Fed to come in and cut rates just to help the economy do a little better than it's already doing. Instead of, oh my gosh, we're falling off a cliff. Now the Fed has to come in to cut rates just to revive the economy. That's a whole different context, even though you're seeing rate cuts when that's happening. And the dollar was up. That's pressuring stocks a little bit because if you go back through 2025 and the dollar going down, that's what's really helped stocks to go up because stocks like a weaker dollar for the conversion rates, for the import-export relationships. And we are going back up a little bit here with the 10-year yield. We're back up to 4.28%. We get concerned if we get up to the 4.5% level. So we're still a ways from that. We did tick down a couple of notches as far as sentiment. We're still positive, but we were at 64 after Friday. Now we're at 62 after Tuesday. But now we're starting to turn more negative here. The ADX is seeing the red line crossing above the green line. So our bias is negative and our momentum, I'm switching it over to mixed to negative because we're mixed. That's the more positive side of things. Negative is some of this weakness that we've seen over the last couple of trading sessions. But we're looking more negative from a trending perspective as well, and I'll show you that chart. So we have the ISM manufacturing, which actually was okay. It came in better than expected at 48.7. They thought it was going to come in at 48.6. Last time it was at 48. So that's an improvement, and the market could have rallied off of that and said, oh, look at this. Now we're under 50. That's showing contraction, but we are improving. So the market could have used that as justification to go up. Construction spending was weaker than expected, down 0.1%. They thought it would be up 0.2%, but it's an improvement from last time where it was down 0.4%. And I don't have charts for this one, but the global U.S. manufacturing, this is still looking fairly healthy. It's down a little bit from the previous reading at 53, where it was at 53.3, but it's above 50. And so that is showing expansion globally here. So here are the charts. ISM manufacturing here. And we're going up with orders and we're going up here with the index, the total index itself. So that actually showed some improvement. And the prices and deliveries, prices are coming down. That's not inflationary. And deliveries are going up. That means companies are receiving these products. So that's taken as positive. And the import exports, we're coming down with the imports and up with the exports. Now, because of the tariffs, because of the trade deals, that's kind of what the U.S. is trying to do. Instead of buying all these things from other countries, let's make them ourselves and then sell our stuff to other countries. And that's what this chart is showing. There's a bit of an improvement in that. And the index itself, still below 50. That's the dashed line here, but it ticked up from the previous reading. Construction spending below zero, kind of flatlining right now on a year-over-year basis. Not really seeing a lot of improvement there. And then the residential, a little bit of a tick up. That's the blue line where we're pretty much flat with the non-residential construction spending. And then month over month, we did decline, but it was less of a decline than what we saw last time. Okay, so then, now this isn't, I think I got this on X or Twitter, what have you. Whenever I run across one of these charts, I like to bring them up in the videos because it all depends on your perspective of things. Are you more of an optimist? Are you more of a pessimist? A perma bull, that means you're always optimistic about things. Are you a perma bear? That means you're always pessimistic about things. And it just depends because this is the same chart. This is a 2 hour chart of the S&P 500. Here, going back to the early part of August here, but these charts come up all the time. And what you see here is a head and shoulders bottom. Okay. And from that, that's usually a positive thing. You have your left shoulder here, and then the bottom, the head, and then you start to break up out of that, and you think, oh boy, we're just going to go up from here. I don't use these patterns all that much. I like to be aware of them. There was a few weeks ago, we were seeing a bearish flag that was being drawn. Well, we just blew the, and a lot of, I can only guess, but there was probably a lot of bears out there that were just salivating, thinking this is going to lead to a pretty big decline. Didn't. We just blew right out of that and kept going up and set all-time highs with the S&P. But then other times when this is looking more positive, and then we end up breaking below support and looking more negative. So the top chart, that's a head and shoulders bottom, which is considered positive. And then up here, you have a head and shoulders top. The same type of chart formation. This one's a little bit longer, but this leads you to a bearish conclusion, even though you're looking at the same data on the top and on the bottom. So that's why you can have different folks looking at the same thing and reaching different conclusions. All right, then equity positioning still above zero, coming down just a little bit here, but they're still net long in stocks, according to this chart. And we are seeing a drop off in heavy truck sales, which that's kind of where we've been. We've been range bound now for the last number of years. And then discretionary versus systemic or systematic strategies here, where the systematic strategies, they tend to do better when the market is going up. And it's like, oh, okay, dollar cost averaging. I don't really pay attention to what's going on with the market. I'm just putting my money into investments as we go along. Where the discretionary, that they try to pick and choose. It's like, okay, we're getting into a difficult time now. Maybe I better go out of the stock market, maybe into the bond market, or maybe into a money market or something like that. They tend to underperform when the market just keeps going up and up and up. And that's what we're seeing here. Mega cap growth and tech positioning coming right back up. It's just still slightly below this dashed line, which is the median here. And then buy it back. Apple, they've already announced the biggest repurchase and so far this year. And then these are the big companies. These are the ones that a lot of people really like. A lot of them are the Magnificent Seven stocks, and this is seen as positive when companies are willing to come in, use company money to buy company stock. That takes some of the shares off of the market, which makes them more precious. And it just shows, okay, if a company's willing to buy their own stock, maybe I should be willing to buy some of that stock too. And sector fund flows, seeing a little bit of a change here. The industrials, which have been doing quite well, they're actually outperforming tech. Usually we see this yellow line tech way at the top and kind of all by itself. Now, lately, we've been seeing financials coming back, and that's encouraging because over the summer, going back to last spring, I'll show a chart later on. We've been worried. Now, the financial sector has been doing pretty good. It's just been underperforming the S&P, but over the last week or so, that seems to be improving. But we're not switching back to seeing the financials outperforming the S&P yet. Then this is a different source for these charts. This is the dollar and rate differentials. The fall in the dollar explain almost entirely the rate differentials moving against the dollar. Okay, so here, just a way of analyzing the dollar. And then another one at the dollar here, the MSCI World, excluding the U.S. stock price divided by the S&P. This, I look at ratios like this, especially in the intermarket analysis video, against real trade weighted dollar index at the right inverted scale. Okay, so we're getting to a pretty low reading, kind of back similar to where we were back in 1985, where we bottomed there. And then right after, this is the dot-com bust. Are we starting to bottom out now with this? Is this actually looking a little bit more positive? ETF flows, okay, we're seeing some negative divergences here. When you see into SPY, VU, these are S&P 500, VTI, the Qs, VUG, that's growth and value. We're seeing less money actually going into these areas and less of the percent of assets under management. So there is some money getting pulled out of these areas. And whoever, Andrew Thrasher from Thrasher Analytics, is seeing this as a more negative divergence. Investors seem to be pulling assets from major equity index ETFs. Is this a result of traders trying to front run bearish seasonality in September? If they're wrong, then this bearish flow activity could set up a contrarian move that fuels the next leg up. Okay, and we'll be watching to see if something like that happens. There was a little bit of that in Tuesday's session. We were going down, we saw some buying later in the day that took us up off of the lows. Then bearish talk and flows. 2025 in two charts. Well, good luck with that. Media mentions of the word bearish tripling year over year, other words like stagflation. I don't watch the financial media. I think it's a complete waste of time. I watch the charts. Now, I might flip on Bloomberg or something like that when they go live on YouTube and when like the employment numbers are coming out or when CPI or PPI or something like the Fed's going to make an announcement, I'll do it for that. But then once they shift over to their little panel where they're going to discuss things and come up with all their interesting conclusions about what's happening, that's when I stop watching at that point. So, um, let's see. So the market likes to climb a wall of worry. And if you hear a lot of negative things in the financial media, that's usually when the market keeps going up. It's when it's like, oh boy, there's nothing holding this back. Boy, things are just looking so good. The party's just going on and on and on. That's when you want to get really nervous. When the financial media kind of gets behind the market going up. So they're doing all this doom type reporting while the SPY hits all-time highs repeatedly and ETF lows are 12% of last year's record pace. In other words, doomerism. Haven't used that one before. I usually say doom and gloom, but here, doomerism has simply fallen on deaf ears. No, it hasn't fallen on deaf ears. People listen to this and they make decisions based on this because they don't think critically. They don't look at the charts. And so the people that are losing out, those are the ones that go into the doomerism. Now, there's a certain crowd out there that are permanently bearish. And no matter what's going on, the next crash, the next significant decline, everything's going to fall apart. It's always around the corner. But I followed a few of these people over the years, and that just around the corner has been going on for 20, 30 years now. And then they get all excited when we do see some kind of a decline. I mean, what a terrible way to live, in my opinion. Waiting for bad things to happen. I just don't understand that. Credit spreads. Now, I go over this when it's doing something. I use the chart in the daily video, but then I look at it over the weekend in the weekly videos as well. And basically, what we're seeing right here is a very low spread. This is the spread between risky and not as risky bonds. And you could take this as positive. Look at this like you would the VIX. When we're getting a very low reading in the VIX, the market's going up. But at the same time, you could turn that around and say, okay, the bond market's getting rather complacent right now, and that's usually when we top out. So again, you want to respect what you're seeing, but then you have to wait for clues instead of reaching a conclusion. You look to see, okay, what's developing here? Are we seeing a real complacent environment that's going to turn negative, or is it still maintaining more of a positive stance? Okay, this is that same thing. This actually was a chart that I showed in the previous video for Tuesday. It also showing how this is really low. Again, interpret this like you do the VIX. A low reading means that the market is more positive. All right, here is the chart. And we gapped lower. But really, if you look from the time we opened until the time we closed, not all that bad. We saw a real gap down that produced most of the damage, which is different than what we've been seeing over the last few months. We've been seeing a more lethargic futures market, and then the real price action tends to happen while the market is open. Well, we saw most of the damage come from Friday's close to Tuesday's open. And then we came down, we did find some initial support here at S1, came up. This is the 6,400 level, couldn't really get above that. Came back down, then we went down to 63.60, and that was where we set the low. And then going from a little bit before lunch onward, this is some pretty significant buying. Now we pulled back here, but this is a pretty healthy looking pattern. So for right now, this is, I mean, yeah, we were down and it was a down day, and we're seeing some little bit of damage being done on our daily charts. But this is fairly positive. That's why I follow the intraday charts because you can kind of get a better read on what's the market actually doing rather than, oh, we were up or we were down. And then here we did see a drop off here with the futures. Now they were pretty calm on Monday when the U.S. market was closed for Labor Day. It was when Europe started to open and then things started to kick into gear for Tuesday. That's when we saw things really dropping down and getting worse. And then we saw the drop off in the cash session. We're dropping down a little bit here, but I checked the futures and they're not all that much different. But this is 8 or 9 hours before the market even opens. Now, this is negative, but possibly improving. The red line is above the blue line. That means value is outperforming growth intraday, but they both had a nice little bounce back up here. Now, this we would like to see the blue line get back above the red line. We're not seeing that yet, but the fact that they're both going up, where we saw pretty much an opposite on Friday, where the blue line came down, the red line stayed pretty much flat. That was growth underperforming. Where here they were performing more in line with each other intraday, at least on a price pattern basis. And this is looking a little vulnerable right now. We were going up with the growth to value ratio, and then we really dropped off later as we worked our way through August. And then we dropped down here now that we're getting into September, but a little bit of a bounce back going up into the end of the day. So, at end of day, growth was down more than value. All right, so a little bit of damage is continuing to be done with those ratios, but it was down less for the mid caps and it was down less for the small caps. So we're still seeing some weakness after we had been range bound here with the end of day growth to value ratio. We're below the 50-day moving average and not a real big change with mid cap growth to value, where we did come down a little bit here with S&P growth to value and we're below the 50-day moving average. Going back to the beginning of August, this is the vulnerability. This is when I see we're seeing this shift over from growth to value. That really started at the beginning of August. But the bigger picture here is that we're still looking okay. So this is looking more vulnerable in the short term. Longer term, we're still looking positive. And coming down a little bit more into the rainbow with the growth to value ratio here, and a little bit of a tick up actually with discretionary to staples. We ticked down on Friday. But this has been a better performing ratio as of late. Once we started to get through the latter part of summer, this ratio started to show some improvement. And that's what we want to see in a more positive environment. Now, we did come all the way down to the 50 period moving average with the large cap growth ETF. So this support area is holding up. We opened, we came down, we set the low, and we closed up off of the low with this ETF. So yeah, it's negative since it was down, but it did repair a lot of damage in Tuesday's session. Also seeing a little bit of a move up here deeper into the rainbow with the value to growth ratio. We want this ratio to go down. The last few sessions, it's been starting to go back up. So here is where we're turning negative in the short term. We were really close after Thursday last week. The ADX, which is the black line, it was starting to cross above the moving average and the green line was above the red line. It's like, okay, we're switching back and looking more positive. Then Friday happened and kind of blew that out of the water, meaning that we crossed back down below the moving average. And then with Tuesday's decline, now we're actually turning more negative. We're seeing the red line crossing above the green line in the short term. We never did cross above the moving average in the intermediate term, and now we're starting to turn more negative here with the red line above the green line with our ADX. And we're still below average with volume. You can see now, my theory was that once the weekend got over, we would see a pickup in volume. Now, it was only Tuesday's session, and there's other things coming out later in the week, and that could easily pick up. But we're still below average, even though we're less below average than we were last week. All right. Now we see this every week. But this is too slow for me because it only comes out every week. Plus, it's a composite of a bunch of different sentiment gauges together. The idea is nice, but it moves too slow, in my opinion. But we're coming in at 75.52. We had been up into this dark red area, which I would say is extreme positive. Now we're coming down more into just the positive area at 75.52 here. This came down a little bit. This could be a little bit of support for the market. These are legal insider transactions. We were going up here, and that tends to be more bearish for the market, and now it's starting to come back down. And we did come back up above the moving average on a closing basis, but we're still below 20 with the VIX. We're also above the moving average here with the bar chart. And this is what we're concerned about here, what historically happens. But it usually happens back in August, but it really hasn't developed to this point. Is it going to develop more as we get into September? And we're above the moving average with the VIX of the VIX, the volatility of the VIX, both with the bar chart. Even though we closed at the low, we spiked up and came down. But on a closing basis, we're back above the moving average with the line chart. And we're still getting a pretty high reading here with the skew index. When we're up in this red area, the market's expecting some kind of a big move. And the reason I draw the arrows is we're not really sure if that's an upward move or a downward move, but we're still getting a pretty high reading here. And we're seeing some fear coming back into the market. This ratio went up and the other ratio also went up. So an increase in fear there. We went back up with the daily equity put call ratio chart. We're going up with the 5-day chart, which is negative. That means there's more puts than calls. And we're going back up with the 10-day chart. That's also seen as a little bit more negative. And we're coming back up. We're peeking our head out of the range here with the volatility risk premium, where this had come down into the lower end of the range. This, when we were seeing a really high reading here, this is just before the August employment report came out. And then the report came out and the market tanked, and we actually fell below the 20-day moving average. Well, since that, as we worked our way through August, this had been trailing lower. Now it's starting to go back up again. So it's picking up an increase in fear as well. And we're in the bigger picture, still looking good with the advanced decline line, even though we declined based on price and volume. And we're starting to drop more negative in the short term. The blue line is the 19-period short-term advanced decline ratio. You can't really see it here, but the red line is still above zero. And then I break this out. This is the advanced decline ratio, short-term, 19 periods. We're falling below zero based on price. We're also falling below zero here based on volume. And we actually went up after Friday with the 10-day advanced decline oscillator. Now we're coming back down, but we're still hanging on to being positive since we're above zero. But the context now is that it's turning more negative. Rolling over a bit here with our 5-day, and we're flattening out here with the 10-day moving average of the new highs, new lows. And we're not really seeing an expansion. There was a few more new highs than what we've been seeing, excuse me, new lows than what we've been seeing. But it's more of a drop off in the new highs, not so much an expansion in the new lows. And that's causing the moving averages to stall right now. Positive here, and get this, we had a down day and accumulation distribution went up. There was some buying that went on, and a lot of that happened later in the day. That tells us, at least to this point, that the market is perceiving this just as a pullback, nothing all that significant. But in the bigger picture, we're a little bit concerned because throughout the month of August, we've been seeing this posturing of switching from more growth over to value. But for right now, we're still going up with accumulation distribution, even though we're continuing to decline on the shorter term basis with the boom indicator. And we went up here, shaking money flow, down day, but this didn't break out. It had a really good reading on Friday, which was a down day. So there's some buying into weakness that we're seeing, and that carried over into Monday's session enough to keep the red line going up. So smart money indicator number 2 is positive. And even with the down day, we declined with the Chaikin oscillator, but we went up here in Tuesday's session. So there is some buying that's happening. Now these are kissing right now. They're giving us the same reading. They're both at 0.94. So we haven't officially crossed over negative yet, but we are seeing some weakness here with the vortex. And we came down a little bit, but longer term, the 10-day average of the highs and lows for the S&P still above this green line, still giving us a longer term positive reading. And we're seeing a little bit more weakness coming into the mid caps and small caps, coming back down to their moving averages, where we did decline with the S&P, but still above the moving average. And the same is true with the NYSE common stock. This is still looking pretty good, a little bit off of the recent highs here, but the 5-period moving average of the highs and lows across the broad market, that's still holding up for right now. And then those stocks in the S&P that are above their 20-period moving averages, that really declined, but still is above 50. Now, you could also make a case here. I mean, I've been pointing this out with other charts. We've been going up with the S&P, and we're setting a series of lower highs here with this particular indicator. And also a bit of a negative divergence here with the 50-period moving average study, where we were going up, and this really wasn't going up with it. And now we're making lower highs and declining, even though this is positive since it's still above 50. A little bit of a decline with the 100 period moving average study, but not really much in the way of negative divergences here. And declining and also seeing a series of higher highs for the most part. We started to level off here once we got into August, but we did make a higher high. This is still looking positive, even though it declined in Tuesday's session. So we came back down to this pivot point. This was for August, and that's about where we settled on Friday. Now we're coming down and starting to deal with this next pivot point here, the solid blue line. It's probably hard to see. That's the pivot point, and we fell below that. That's negative on a bigger picture scale. Well, we were able to come back and close just slightly above it. So it's still hanging on to being positive. Now, this is just the first trading day of the month, and a lot can still happen. We can only analyze what we're seeing right now here, but we're still in an uptrend and we're still below average with volume. And a bit of a decline here with the 20 period moving average study. We're flat with the 50 and pretty much flat with the 200. Not a lot of damage there. Here we're starting to see some negative conviction building. The Stochk RSI is already extreme negative. The Williams %R, which had been extreme positive, is now dropping below the midpoint. And if we continue to go down, it's going to come down to this extreme negative reading pretty quickly. And the CCI 14, which is shorter term, it's already dropping below this extreme negative reading here. We're crossing below the midpoint with the CCI 20. And here's the stochastics. Crossing below the midpoint, excuse me, and looking negative with the short term. We're no longer extreme and now declining with the intermediate short term. We're still extreme. Excuse me here. Gotta love take one videos. We are coming down, but we're still above the moving average and we're still getting an extreme reading with the long short term stochastic. Dropping slightly below the midpoint with the force index. So for the first time in a while, that's looking a little more negative. Seeing a little bit more vulnerability with the short-term trend. This is a double and triple exponential moving average based on 20 periods. The lines are starting to roll over. We spent 2 days now below these lines, but we've been there before and we're able to recover. If this continues to go down, naturally that's going to turn the short term more negative. And we did close below the 20 period simple and exponential moving averages. This could be acting as overhead resistance right now. Now, the other time that we were below this, as I mentioned earlier, this was when the employment report came out at the beginning of August, but we didn't stay there for very long. We came right back above the 20 period moving averages, and pretty much coming up out of the April lows, all of this has been happening above a 20 period moving average. Now we're below it again. Are we going to stay below it, or are we going to be able to get back above it like we did in August? And then these are anchored weighted moving averages here. They're based on volume and price. And it seemed like, okay, I wasn't able to show this chart for a long time because these lines are so far away and they're continuing to go up because we use them as support levels. So as we had this little breakout here, another line came in. We're not quite down to that, but then this was the beginning of August. Then when we bounced up out of that, well, we fell below this orange anchored moving average here. So we lost this more short-term support. Are we going to hold more at this kind of sickly looking yellow line, greenish yellow here? We'll be watching that to see if that support level ends up holding if we go down and test that. And we are below the 20 period moving averages. We're still above the 50, 100, and 200s here. So intermediate and long term are still positive. And we're a little bit below the midpoint, even though we closed well up off of the low with the standard deviations chart. Since we're a little bit below the midpoint, we're in the -1 standard deviations channel. That's turning that more negative. And we're declining, but still above zero with the balance of power. The go, no go is now switching more to negative. The dark blue, that's positive. The lighter blue is possibility of switching more negative. And we're dropping below the midpoint with the highest high value chart here. But we're still in an uptrend according to the Landry Light, and we're on the 85th trading day of that. We're still positive with the proper order. That's still in an uptrend. But we're seeing some weakness here with the TTM squeeze. Dark blue, declining. That is actually turning negative. We're dropping a little bit below zero with the ease of movement, but going back to the spring, after the gyration that we had, we pretty much have just been hovering for the most part above zero. We'll see. Are we going to continue to go down below zero? We're still positive with the Arun. We're above zero, even though it's flat. That's giving us a positive reading there. And then the S&P McClellan Oscillator, which was barely negative after Friday, it's even more negative now. This is more short to intermediate term, and that's declining. And when that's below zero, we decline with the summation index based on price, and we're also declining based on volume. This is more intermediate term, and we're seeing more weakness developing here. And we were slightly above zero after Friday with the NYSE McClellan oscillator, a broader market measure. We now dropped below zero here. So now it's really hard to see, really choppy through August based on price, but it's declining with the summation index based on price, starting to roll over here based on volume. And we're negative with the Swindle trading oscillator. See, a lot of this movement based on price was not too far above or below this red line after we finally came up out of the down day that we saw at the beginning of August. Just been kind of drifting down here based on price. We're drifting down here based on volume. This is now negative. And our momentum oscillators continue to drift off here with the PMO declining. We're flat and now starting to decline a little bit based on price, where we have been declining with a little bit more conviction here when we look at the S&P based on volume. And we're falling below 50 with the PMOs that are rising. The buy signals are now going down, but still slightly above 50. Starting to roll over a little bit with the PMOs inside the S&P that are above zero. And we came all the way down to the 30-period exponential moving average. And this support level is held. This is about where we held on that down day that we saw in August, and then we came up out of that. This is the bearish flag that some folks were probably picking up on. And then we were able to break above that. That pretty much negated it. Then they thought, oh, it's just a delay when we came down here. And then we went up and set new all-time highs. All right. And then the intermediate term trend based on 50 periods, seeing a little bit more vulnerability here. The red line's starting to turn down slightly. We're still going up, but flattening out with the blue line. And price is above both of the lines. And now we're going to be watching the 50-period moving averages. We're below the 20s. We'll see, are we going to come down, and will this end up, first of all, will we come down to this point? And if we do, will this level end up holding as support? And we're negative after being neutral with the Elder's Impulse system for the S&P, and this is a big change here. We've been positive with the parabolic SAR with the dots underneath. After Tuesday, we now have a dot on top. Now we had one day, going back to July, where we had a dot on top and then we broke to the upside. That's rare. You usually don't see only one dot. You might see a few, but not usually just one. So if we see more weakness and the more dots that get drawn in here, the more the intermediate term trend could be turning a little bit more negative. And then our short-term oscillator, the slope oscillator, declining below its moving average. That's negative. Declining with the MACD, which is more short to intermediate term. So now we're going down with the short-term oscillators, the intermediate term. I have three of those here, and we've still continued to decline with the long-term oscillators. And we're negative with the Copic curve. It had hung on to being positive for most of August. Now it's starting to drop over negative. And the Sean trend meter, which is no longer extreme, I still have it on the list because we're in this green area. If we drop down out of this green area into this kind of sickly looking yellow area, that's when I'll probably keep it off the list. Plus the context is that this is now declining. We're below 50 with the money flow. The first time now, going back to last spring, that we actually dropped below 50. And we're declining, but still above 50 with the ultimate oscillator. We're still above the moving average here with unbalanced volume. So even though it declined, it's hanging in there for right now. We're declining, but still above 50 with the intermediate term RSI. We're starting to drop below 50 for the first time, again, when we had that big down move at the beginning of August. We'll see. Are we going to see this continue to decline with the short-term RSI? And we're negative with the bullish percent index. We fell below the moving average after Friday. We're continuing to decline now. That's negative. We're declining, but still above 50 with the NYSE bullish percent index, and we dropped below 50, so that's even more negative. The negative number one is because we're declining. Negative number two is because we drop below 50 with the NASDAQ 100 bullish percent index. But here's this whole praying bottom fisher buy signal that keeps being generated here, and it's still saying buy, buy, buy. We'll have to see if that ends up turning into anything. And then I show this when we start to deal with the mini rainbow. We actually drop below the rainbow, but we're able to close back up in the middle of the rainbow. And this is just a 20-period simple moving average of the open, high, low, and close. And this is probably what I've been harping on the most. This is longer term. It's a weekly chart of the S&P. We got above this R1 pivot point here on Thursday. We got above 6,500. Well, then we closed below it on Friday. So for 3 weeks, we've been dealing with this overhead resistance and have not been able to close above that. And it really only counts where we close on Friday because this is a weekly bar. Now we're starting to come down a little bit. Are we going to be able to go back up and give this another test, or is this the beginning of a longer term decline? Also, at the upper end of this trend line, we've been here now for quite some time. That's also acting as overhead resistance. Looking a little more negative with the Heiken Ashi, with the black candles. We're positive since we're black, but we're pointing down with the Kegi chart. Still positive with the Renko chart, but now we're looking a little bit more negative with the three-line break. So some of a mixed picture there. Longer term, we were actually a little bit extreme here with the 150 moving average study. And I put this line on here so there's nothing magical. It's just when we get in this range, we watch it a little bit closer. But now we're dropping down from that red line. Still looking positive though, even declining a little bit with our 200 period moving average study as well. Now, and I kind of made a big deal, maybe not a real big deal, but kind of a big deal over the weekend with the Zohorchak method because we were at a full -10, then we bumped up to a -6, then we got all the way back up to a 0. That's what we were seeing over the weekend. Now there's a 1 day lag. And so this is last Friday. And with Friday's decline, we went back down to a -6, which is strange. We don't see this chart move or change all that much. So to have it come back up to a 0 and then drop back down to a 6, a little bit more negative there. And we've turned over to negative here with the NASDAQ 100. It's below its 20 period moving average, and I'll show you that later on. But we're still positive on all time frames with the other indexes. And we're still negative in the short and long term with bonds based on price, still positive with commodities. We've actually switched to an uptrend here in the short term with the dollar. And notice what was up: energy, healthcare, defensive areas. They actually held up better, where everything else, all the other sectors, all nine of them ended up being down, with real estate being down the most. Tech, discretionary, communication, not big changes here, but they were down on the day. So an awful lot of red here. We got below 6,400 with the S&P, and then the Nasdaq, it's like a countdown: 21, 6, 5, 4, 3, 2, 1. And then the utilities had a BPI cross below 80. They've been pretty strong lately, but saw some weakness in Tuesday's session. The tech sector crossed below 50. That's a little more negative. That's the line between positive and negative. And real estate, which had been seeing a little bit of favor with this hope of interest rates being cut, that actually saw some weakness as well. And yet seems to be every day now. Canada sets another new all-time high. So an awful lot of red here in the big areas that really drive the indexes. Here, when we look at tech, discretionary negative, communication negative, and we did see some improvement here with healthcare and real estate really red in this area. Staples a little bit stronger there as well. So the Dow still above this pivot point here for August, and we are still in an uptrend. We're still neutral with the Elder's Impulse system for the diamonds, and we fell below this pivot point here with the NASDAQ, but we're still above the 50-day moving average, but we're negative with the Elder's Impulse system for the NASDAQ. Also, we actually fell down below the 50-period moving average with the NASDAQ 100, but we were able to close back above it. So this support level has held so far. Negative with the Qs, looking at the Elder's Impulse system. Also, kind of a healthy looking bar. We opened and then we went down and then we closed well up off of the low. But we're still negative with the momentum for the NASDAQ 100, and we're down below the 20 period. That happened on Friday. Now we're testing the 50 period moving average, but we were able to close back above that with the QQQs. Coming back down here with the longer term trend line when we look at the NASDAQ weekly chart. And then we look at the small caps. Recent golden cross for the S&P 600. They gave some of this back here. We've seen this over and over. Have a nice solid up move, and then we spend time giving back. Is this going to be more short-lived, or are we going to see more of a decline here? Also, but looking okay. We opened more at the low, closed more at the high, even though it was a down day here for the Russell 2000 small caps. Still neutral with the Elder's Impulse system for the small caps. Mid caps were down as well, still above this pivot point, still in a longer term uptrend, still neutral with the Elder's Impulse system. The Wilshire, which set an all-time high on Thursday and then it was down on Friday and down again, it closed up well off of its low as well. Also, recent all-time high with the total U.S. stock ETF closing up off of its low. Financial sector, it was down, but it just is coming off of setting recent all-time highs when you look at the chart by itself. We're seeing a general improvement though when we do a ratio between the financials and the S&P. This will be more positive. See how we were developing through this, going back to late spring and through the summer. We just saw this ratio continue to go down, down, down. And that's a warning sign. The financial sector, we want it to do well. That's signs of a healthier economy and a healthier stock market. If this can continue to go back up, that will just show more improvement. The FANG index came down, tested its 50-day moving average, but was able to close up off of that. So Apple was down over 1%. Amazon was down 1.6%, a little bit above its 50-day moving average. Kind of dealing with its 50-day moving average with Microsoft here, down 0.31%. Coming off of a recent high here with Google. Meta down over 0.5%, dealing with its 50-day moving average. Nvidia just can't seem to find any love right now since they came out with a good earnings report, but the projections forward weren't as positive as the market had hoped. It's dealing with its 50-day moving average. Tesla's been chopping around all over the place here lately. And Netflix was actually up, but still below its 50-day moving average. And we want to keep an eye on the semiconductors. They're back down to dealing with their 50-day moving average. We're just a little bit above that here. And we're a little bit above it here with the SMH semiconductor ETF. But we're seeing some weakness here, but it's not rolling over and going negative when we look at the rainbow with the SMH ETF. Seeing a little bit of a drop off here with the correlation between US and world stocks in the short term, still tending to go up here with the longer term correlation. And oil, we're in the mid 60s here, to up over 2.5%. And we're back above some moving averages here with the dollar. But it looks like we're starting to get a rebound and then it just falls back down. But it did bounce up, and that could be pressuring stocks, especially if that continues. We did go back up with the 10-year yield, but we're well below this red line, which is at 4.5%, dropping off with the 10-year based on price. So this is where we've been seeing this gradual deterioration here. We look at the Qs to S&P, below a declining moving average. Now, discretionary, the S&P has been holding up better. It's still above an advancing moving average, but it's not showing a lot of recent strength. And we're also dropping below a declining moving average when we look at large cap growth to value. So we're below the moving average with the large caps, mid caps, and small caps. All right, so what's our outlook then? Oh, that's nice. If you didn't get this already, the markets will be closed on Monday for Labor Day, even though this is now Wednesday. All right, so okay, I didn't update this part. But we are below overhead resistance, and now we're even a little bit further below it. We are going to get the MBA mortgage applications index and factory orders. Kind of a light day as far as economic reports. And then anything that may develop as far as the trade deals, tariffs, geopolitically. I mean, there's so much going on. It's like the world's kind of ignoring a lot of stuff that's happening right now. And then Thursday and Friday are going to be the big days. We have initial and continuing claims on Thursday, unit labor costs and productivity on Thursday. That's a pretty big one. Now, we had ISM manufacturing on Tuesday. We're going to get ISM services on Thursday. And then the biggie is going to be the employment situation report on Friday. So this also shows the economic calendar for the week. Seasonality, when we just look at September 3rd, going back to 2002, we're positive with the Dow, but we're neutral to negative with both the S&P and NASDAQ. And then we look at September, and this is why people are a little bit uneasy. But it's not like the stats for August were all that great, but September's even worse. We're only up 46% of the time going back to 1964, and it's a negative 0.7% return there. This is a newer chart here. It says September is the worst month of the year going back to 1950. And so just, yeah, not awful lot of positive things about September. But we tend to perform a little bit better with the first half of September than we do with the second half of September. This is a little bit outdated now, but this also shows the weak seasonality that never really did develop in August. We're wondering if is it going to make up for it in September, or are we going to prove seasonality wrong like we did August? And then going back to 1950, we're up 33 out of 74 times. We're down 41 out of 74 times with the negative 0.7% return. So I'm keeping the smart money indicators on the negative side for right now, even though they're kind of looking a little better here. Accumulation distribution actually went up. It's mixed because of the short-term boom indicator still going down. And we did go up with the Chaikin money flow, and we are positive with the Chaikin oscillator. So there is some buying going on. And the S&P McClellan oscillator, the NYSE should also be on this list as well. The parabolic SAR is now negative. Our oscillators are looking more negative. The swollen trading oscillator is negative. All the BPIs, the bullish percent indexes, especially for the S&P, is dropping now. The money flow dropped below 50, and the momentum for the NASDAQ 100 is negative. So, bigger picture though, we're still looking okay with our growth to value ratios and discretionary to staples. It's more shorter term, we're seeing some vulnerability that's been coming in. And then we're still above 50 with the NASDAQ 100 and NYSE bullish percent indexes, but they are declining. The ease of movement is still above 50. The ultimate oscillator is still, hold it, ease of movement, that should be negative. It dropped below zero here. The ultimate oscillator is still positive. See, I had a 3-day weekend too. The vortex, they're kissing each other right now. They're even with the red line and the green line. The financial sector, but we're seeing some improvement, but bigger picture, it's still been underperforming the S&P, and we're still dealing with a praying bottom fisher buy signal. And then over the weekend, I go over the long-term special K chart. Both the daily and weekly chart are still positive. So here are the pivot points for Wednesday's session here. Okay, the conclusion. We're negative in the short term. I did update this part. We're positive in the intermediate and long term. We're below overhead resistance. In the short term, we're seeing some conviction starting to turn more negative, and we're below the 20 period moving averages. We are still positive. We're seeing some weakness developing, like with the summation indexes, with the bullish percent index, and things like that. But it's we're going to need to see more of that to become more convinced. Plus, we're still above the 50-day moving average. We're still positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.